In this module, we are going to discuss the audit of less complicated entities. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, it's particularly important in less complicated entities to apply the risk model so that we can be efficient and effective. And the risk model and professional standards actually contain a number of hints as to how you can do the audit of a less complicated entity in a less complicated fashion. Now, regulators are proposing that there be a second set of standards, the second set being for the audit of less complicated entities. And I really don't want that, because that means that I will have to learn two sets of standards, one for normal audits and one for less complicated audits. And I'll have to have two sets of forms. The other thing I will have to do is I will have to waste time before each audit, because I'm sure there's going to be some list of criteria in standards, and you're going to have to go through that list for each audit and decide each year whether or not you're entitled to use the first set or the second set of standards, and you may have to flip back from using the less complicated to the more complicated audit standards, and that'll be a lot of fun. So I really don't want to waste my time doing that. And I particularly don't want to do this because, in my view, current standards address less complicated entities perfectly. There are many places in standards where the standards say, hey, if this is a simpler audit, do it this way. So the problem, I don't think, is standards, but how we apply the standards. So we have a less complicated audit, and we decide to do the audit in the most complicated way we can imagine. So the first tip I have, these entities are less complicated. Don't use a really complicated approach. Find a less complicated approach to do this less complicated entity. Second tip, the risk model, the fundamental message of the risk model. If risk is low, very little audit work is needed. Perhaps only a simple analytical procedure or two and a simple control test or two. And I'll give you a mathematical example of why that might be true later on. Now, clearly, if risk is high, we're going to need to do more work. And if risk is very high, we're pretty much sure that the number is wrong and we know why. Well, then we're going to have to do a lot of work. But then also we should tell our client, look, you've messed up this section. We had to fix it for you, do the bookkeeping for you, and there will be an additional fee. The first corollary to the second tip, don't assess risk as low and then do a whole bunch of work. If risk is low, do a low amount of work. Corollary 2 to the second tip, don't assess risk as low and then go, oh, well, I know we developed an audit program for low risk and it didn't have a lot of work, but in my auditing textbook, there's this test and that test. Well, let's do this test, and this could be wrong. And oh my goodness, and there might be fraud. We better throw in some testing for fraud because we always have to test for fraud. Everything might be wrong. Well, you're contradicting the risk model and contradicting the plan and doing too much work and auditing a less complicated entity in the most complicated way you can possibly imagine. Third corollary. One of the ways we do audits sometime is we redo the accounting. Well, don't do that. It's easy. You don't have to think, but it's time consuming. And often we don't like to bother to think, and we'll do an enormous amount of work so that we don't have to think. Whereas if you'd stopped to think, you could have saved yourself a bunch of time and found a less complicated way to do the less complicated audit. Now, redoing all the bookkeeping might be appropriate for a very high risk of material misstatement. If the client never records payables, well, we're going to have to do it and send a separate bill for it. And we're going to do all the accounting the client would have to properly record payables. Now, maybe we can shortcut it a bit by doing subsequent payments for 3 or 4 months and see which of the subsequent payments were actually payables, but that's going to be a lot of detailed work and annoying. But if the client hasn't done it, we have to do it. If risk of material misstatement is low, think and find an efficient audit. Don't do your audit by doing the accounting. Find an audit approach. Third tip, if the entity is less complicated, risk of material misstatement is almost never high. And indeed, in a less complicated entity, if you concluded after doing planning that for every component, risk of material misstatement for all assertions was low, could be true, probably is true. That's probably correct. And if you have 10 less complicated audits and all of them have risk of material misstatement is low, it's probably correct. Some people I see feel, well, I think I should have a couple of assertions with high risk of material misstatement, so I'm going to pick 5 or 6. I'm going to pick the 5 or 6 that are highest. Now, they're still low. They're on the high end of low, and everything else is on the low end of low. And if it's on the low end of low, you can probably do a low amount of work. Never mind. But none is right. If none is right, none is what you should assess things at and have no areas of risk of material misstatement that are other than low. It's probably okay. Fourth tip, and people sometimes throw in a whole bunch of extra work for fraud, and they go, oh, well, fraud. We have to consider fraud. Well, risk of material misstatement is defined as either the risk of fraud or the risk of fraudulent financial reporting. And we as auditors actually don't care about fraud. Somebody stealing supplies from the stationery room is defined as fraud. But we don't care. Because at year end, A, it's not a lot of money, and B, at year end, either we don't value the stuff in the stationery room or it's all counted, and if anything got stolen or not accounted for correctly, it's fixed. So someone stealing inventory is fraud. We don't care as long as the financial statements at year end have had the results of the fraud removed. So if we count inventory at year end, somebody stole a bunch of inventory and we go, gee, I wonder why inventory is lower than it should be. Well, somebody stole it and got lost, something. We don't care. Client will care. Client will want to investigate why, but we as auditors do not care. As long as the financial statements are not materially misstated because of the fraud, we don't care. And we have to be careful as we talk to clients, because if we go, oh, we don't care about fraud, they're going to go, what do you mean you don't care about fraud? So we have to pretend at least we're worried if somebody is stealing something from them, but it doesn't affect our audit. We only care if the financial statements are materially misstated, and then we only care if it's fraudulent financial reporting. Now, we do need to think separately about that, but you can think about error, you can think about fraud, and then come to a joint assessment of risk of material misstatement being low, and do a low amount of work. And here's an example of a section where this kind of thing happens. Prepaid expenses. Last year and this year is similar. Prepaids were $31,420 in prepaid property tax and $11,820 in prepaid insurance. Now, if someone were to offer me, what's that, $42,000, $43,000, I would take it, and that would be a lot of money to me. Okay? So it's certainly a fair amount of money. The client has provided us with a copy of the property tax bill and the insurance invoice. Last year we recalculated prepaids daily. The client did it monthly, and we proposed a $450 adjustment, which after some discussion the client agreed to. So our audit program this year is recalculate prepaids on a daily basis, compare the total paid to the invoice and retain a copy of the invoice in the file, trace the payment for property taxes and insurance to the check and to the bank statement, 25-hour budget. Some other procedures we're going to do this year, we're going to, on the check, paying the property taxes and insurance, we're going to make sure there are 2 signatures on the check. That's a wonderful internal control. We're going to compare the property tax bill this year to last year and get the client to explain why it's changed. And normally the client tells us, well, city increased property taxes. And we'll do the same thing for insurance. And we ask the question, what other procedures could be done? And materiality is $250,000. Now the first thing you should be thinking is, hey, materiality is $250,000. So the client understands they're a big audit, and we're proposing a $420 adjustment. They're probably just being very polite, but in the back of their minds, they're probably going, are you guys nuts? Are you guys charging us too much money for this audit, because if you're doing work to find a $400 adjustment, I think we're being overcharged. So either they're being overcharged or your firm is doing way too much, charging the right price, so work in process is way too high, and everybody thinks this is a bad client because we're spending all this time auditing it, and they can't do their prepaid expenses right. So what we're doing here is procedural and not risk-based auditing. We are doing textbook auditing. We are doing every procedure in the book. We are doing auditing by redoing the accounting, which we're not supposed to do. And we're auditing without thinking. And the number of times I see people doing an enormous amount of effort so that they don't have to do any thinking, where if they put in the effort to do a little bit of thinking, they could save themselves so much time. Auditing without thinking is a bad way of doing things. Now, our prepaid expense section is going to have fabulous documentation, invoice copies, 2 signatures on checks, internal control. It's not wrong. So we have done enough work, but what we should have done is assess inherent risk or risk of material misstatement. We should do that first, not at the end. And I think we can probably conclude $40,000 in prepaid expenses, $250,000 in materiality. The odds that the financial statements are materially misstated because of this are negligible. I just can't imagine how it could happen. So, I think if I do an analytical procedure, I compare this year to last year in total and see that the 2 subcomponents are about the same as well, I think I'm done. The invoice copies the client gave me that have tricked me into actually looking at them, I'll very politely receive, take them back to the office and throw them in the recycle bin or throw them in the shredder. And I will put this in the audit program. Do not do any of that stuff. And I will say the budget is half an hour or even less, because comparing this year to last year, that's kind of a risk assessment procedure that we have to do anyway. But if we add in the expectation, our risk assessment procedure and our audit procedure are the same and we're done. So, prepaid expenses. There is no need for detailed control testing. Client may have controls. We don't care. We don't need to. Control testing is an opportunity for obtaining audit evidence, not a requirement. No need for walkthroughs. No need for extensive documentation. Simple documentation is sufficient. And we've ignored all the tips in the standards. We've ignored all the tips in the risk model. So, fixed assets, the same audit. Now, risk of material misstatement depends on the client, so don't do every procedure. And I remember teaching a course introducing the risk model to staff at my firm, and I kind of asked, okay, what procedures should we do here? And I got every procedure in the textbook. Let's do everything. And what's risk of material misstatement? Well, they could do this wrong, they could do that wrong, they could expense fixed assets, they could capitalize expenses, they could do this, they could do that, they could do depreciation wrong, they could use the wrong rate of depreciation. Everything. Well, if this client has a $50 million in fixed assets, let's say, and it's land and building, the same land and building they owned last year, got some small amount of office equipment, not much in additions to office equipment on an annual basis. Do we need to recalculate depreciation in detail, or can we do an analytical? Can we say, hey, depreciation about the same as last year, good, we're done. Additions. We've done a risk assessment procedure. We found there's not a lot. $3,000, let us say, 6 different items, none bigger than 1,000. What level are we going to examine? Now, sometimes you'll say, well, examine everything above $2,000, and next year people think that that's the number they should use, and there might be a $2,000 addition. I think I would say materiality's $250,000, examine all additions above $200,000. So next year, if there's a $10,000 addition, we won't examine it either. So we've always got to ask, what's the result of our risk assessment procedures? So, have they expensed something in repairs and maintenance that should be capitalized? Well, what did the risk assessment procedures tell us? Well, repairs and maintenance was $150,000 last year and it's $160,000 this year. Okay, I don't think there's a risk of material misstatement that something's been expensed in repairs and maintenance. Maybe I'll scan the GL and just see if any big number pops out at me. but maybe I'm just going to go, this year and last year about the same. I'm good. I don't think there's a risk of material misstatement of something in being in repairs that really should be capitalized. Now, what is the risk that the client will expense something that should be capitalized? You've got to look at your client and decide, what are they going to try to do? Are they going to try to do that or not? Now, some clients, small business driven by tax reasons, might be more inclined to expense something than a large company that's trying to meet earnings targets or something like that. They might be more inclined to capitalize something they should expense. You need to think about that. You need to decide the risk in the plan. You then need to do a risk assessment procedure and conclude, do you actually think that's happened? And do you then need to do any detailed substantive procedures? And if, based on your understanding of the client, you decide none of that's going to happen, the audit of fixed assets isn't going to be terribly time consuming. Now here's a review query, because queries can be something that waste our time, at least annoy us. The bank reconciliation has an $84 reconciling item. Please ask the client for an explanation. Now, is that a valid query? Well, if the audit program says, when doing the audit of the bank, the cash section, provide an explanation of all items on the bank reconciliation above $50, that's a valid query, I guess, but then I would say we have a really badly planned audit. What are we doing setting $50 when materiality is $250,000? But we tend to do that all the time. Some enthusiastic file reviewers looking at the bank record and go, ooh, here's $50, here's $75, here's $200. What are all these things I need to know? Well, you need to have specified that in the plan, and you need to not write queries like that. So if the audit program is sensible, this is a time-wasting query that should not have been made. And depending how brave the audit assistant is, the reply probably should be, materiality is $250,000. Why are you writing this query? Another query in the same audit. Firm policy requires that the reference to a working paper be on the left and the reference from a working paper be on the right. Please adjust. Is that a sensible query or time wasting? Multiple choice. A waste of time. Yes, it's a waste of time. The reviewer could have fixed it themselves more quickly if they really cared. They could have fixed it themselves more quickly than writing down the query. Is it a complete waste of time? Well, it's a complete waste of time for that reason, and now the staff assistant is going to have to spend some time reading the query, adjusting the reference, replying, I've done it, so it's a complete waste of time. If this is something the firm really, really cares about, and I don't know why they might, it should be in a training course, not in a review query. And also, this might be something that should not be in firm policy. We should take it out of firm policy. If you can't figure out where the references are coming from and going to, maybe if that's what the query is, I'm sorry, I just cannot find where this number comes from. You don't have a reference. The reference doesn't appear on the working paper that it's supposed to come from. Please tell me where the number comes from. That, I guess, is a fair query. If the reviewer really, really wants things to be on the left side or the right side, fix it yourself. Or F, something the reviewer shouldn't care about, and I think the answer is all of the above. So as a reviewer, you need to think about the time effect of the queries you're writing, though many reviewers that I know think that their rating, the quality of their file review, is based on how many hundreds of queries they write. And they will say, oh, I wrote 200 queries on that audit. Oh, I wrote 300 queries on my audit. I'm better than you are. To them, I would say, if you're writing a query, every review query is a failure of planning, supervision, or training. And the first two are the fault of the reviewer. You have not properly planned the audit. You have not properly supervised the audit. What are you doing writing these queries? The last one is the fault of the firm. If training is inappropriate and the reviewer is a partner, then all three are the fault of the partner. So when we're planning, what do we do to be efficient and effective, follow standards in the context of a less complicated audit? Well, The first thing we need to select or think about selecting are analytical procedures. They're quick, they're easy, they cover all assertions. They're kind of required as part of risk assessment procedures, but they don't give us evidence as a risk assessment procedure, because when we're doing a risk assessment procedure, we don't need to have documented an expectation. But if we're doing our risk assessment procedure and we know our clients well, and we do document an expectation when we're doing our risk assessment procedures, well, we've got evidence, not much, but maybe evidence about all the assertions in a section, and that's cool because there's 5 or 6 assertions, and we've got a bit on all of them, and we've documented an expectation, which might be as simple as I think it's the same as last year, if we have a good reason for that. The other thing about an analytical procedure is substantive procedures are required for all components and assertions. So an analytical procedure is one. So if you do analytical procedures and control testing and someone says, hey, you're supposed to do substantive as well, you go, well, analytical procedures are a substantive procedure, so I have done the required substantive procedure on every section because I did an analytical procedure. Now the other thing is, having done an analytical procedure and had done it as part of your risk assessment procedures and documented an expectation quickly, are we done? And for prepaid expenses, the answer is yes, we are. And for fixed assets in the section I described, actually maybe we will be. We'll have to do a little more work to find out the level of additions and the level of repairs and maintenance, but maybe we've addressed that through risk assessment procedures, and we're done. Fixed assets. The next procedure we might select is a better analytical procedure. Days sales and receivables, gross margin by product line. Procedures like that give us more than just a broad comparison this year to last year. Document our expectation, and again, are we done yet? And maybe we are, depending on the power of the analytical procedure we did. Now, the next procedure we might decide to pick is a systems walkthrough. One transaction from each type of transaction. Easy to do, depending on how many we do, and gives us some audit evidence. Now, we need to do a systems walkthrough for designed and implemented. There's no evidence provided, but we can do inquiry, observation, and inspection, and not all three. One of them might work, depending on the nature of the component. But if we add inquiry, observation, and inspection to reperformance, we've got some evidence. And if we're doing all 4, remember that we've got evidence from each of those procedures, and we shouldn't throw out the evidence from inquiry, observation, and inspection and focus only on reperformance to get us the audit evidence. Now, some people do that, and if they want to throw away evidence they've got and do lots more work than they need to, that's fine. But a systems walkthrough, one transaction, are we done yet? And maybe we are. After we've done some decent analytical procedures and a systems walkthrough, one transaction of each type, maybe we're done. We're now much more likely to be done. In a simple audit, much more likely to be done. The next thing we might do is corroboration, and corroboration is actually kind of difficult to get. Certainly kind of difficult to get efficiently and effectively, quickly. But it can be easy and done by inquiry, and if it can't be done by inquiry, then probably not. An example I have is if you're trying to find out if the Chief Financial Officer reviewed the bank rec. If you ask the Chief Financial Officer, they will say, yeah, I did. And I don't know if that's very good. But if you go and ask the person that did the bank rec, how often does the Chief Financial Officer come and ask you about things on the bank rec? And if that person says, every month, 2 month or 3, every once in a while they come and say, hey, what's this? I don't understand this reconciling item. What's going on? Why hasn't this cleared? And I provide an explanation, and every once in a while they point out I've done something wrong, and I fix it. If, on the other hand, the person says, no, I've worked here for 5 years and I've never asked one question, then you probably know by corroboration that the control of senior management reviews, the bank reconciliation, isn't functioning. But if you can find one of those, corroboration and do it by inquiry only and do it well, maybe we're done. Now more from control tests. The standard, 20, 40, 60 walkthroughs. It's marvelous documentation. Takes tons and tons of time. For those of you that have done 20, and I forget the rule, if 2 at 20 fail, you've got to do 40. And when you do 40, 3 more fail, and then you do 60 and 6 fail. So it often fails. You do a lot of work and it really doesn't work. It doesn't provide you with evidence. So it's unlikely to be effective. It's certainly time consuming. And it depends if your objective is producing pretty documentation and spending a lot of boring time in the file. Probably not. Doing more than one systems walkthrough, first reason I won't do it is it often fails. It's a lot of work, and then at the end, it didn't work, or it doesn't produce the evidence we want. Now, further substantive tests. So we've gone through all of that stuff, and now proportionate to risk, we have to do more work. So that should have been defined by our statement of risk and material misstatement, and if we know specifically what we think is wrong, we should be able to select a procedure that will directly address it and will directly address the assertion at risk. Now, that may take a lot of time, but if risk and material misstatement is high, well, that's our job, is to find out that whether or not, in fact, there is a material misstatement in the financial statements, and our time is proportionate to risk, so that's okay. Now, the audit risk model, just to prove this mathematically. The risk model is the risk and material misstatement, which is the same as inherent risk, times the first procedure times the second procedure times the third procedure. And it doesn't matter if we're doing a control test or a substantive test, the assurance we get from doing the test, they all multiply together. That's what the risk model is mathematically. Now, for control, inquiry, observation, inspection, and reperformance. Now, maybe we're only doing one because inquiry works really well. But if we're doing inquiry, observation, inspection, and reperformance of only one transaction, and we conclude, you know what, none of these particularly give me a lot of assurance, there's still an 80% chance that the item is wrong. So the procedure has a 20% chance of catching an error. Well, what the risk model says is 0.8 times 0.8 times 0.8 times 0.8 is 0.41. Okay? So actually 4 independent tests that don't really give you a lot of satisfaction each individually, because they combine this way, actually works out okay, gives you something tangible. And then we decide we've done 2 analytical procedures, each with a 50% chance of catching the error, and we decided that risk and material misstatement is low, and 40% literature tells us 40% is low. 0.4 times 0.41 times 0.5 times 0.5 is 0.4. And audit risk is generally considered to be 5% or low. So if we've got audit risk down below 5%, we're done that particular component. So we're done. Now, if it's a transaction stream, revenues, cost of sales, we're probably done. That's probably all we need to do. Some firms refer to revenues as dead transactions because they're done. It's a sale, it's been shipped, it's been paid for, it's been invoiced, it's done. The only not done transactions are the sales that are still in accounts receivable, and we'll catch that when we look at accounts receivable. So balances, you may decide, oh, I've assessed the risk of accounts receivable as low. I have done some good analytical procedures. I've done a systems walkthrough. I think I need just a little more audit evidence. I'm going to do some other, not that extensive, substantive procedure just to kind of top it up to slightly above low. I would feel better that way. So I'm not going to do a whole bunch of work, but I need to do a little additional work. That's fine. Now, I had a client example. A client sold a product for which there were only 2 suppliers in the whole country. And we confirmed the units purchased and the price paid. And these were 2 very reliable suppliers. They got the confirmation request. They were used to it. They got it every year. They got it back to us within a couple of days. So it was great. Didn't have to wait for unreceived confirmations. Now, how much additional substantive and control testing is needed on cost of goods sold? Do we have to look at authorization of purchase orders? Because they had all kinds of purchase orders. Every time they bought stuff, they issued a PO. And when they paid stuff, they had 2 signatures on the checks. Do we have to look at that? Do we have to do a system of walkthrough? Do we have to do D&I? The answer was no. We have 100% substantively confirmed and proved purchases and cost of goods sold. No additional work is needed. No systems walkthrough is needed. Don't care about how they pay for the stuff. I've got it nailed another way. Maybe we have to do D&I. Maybe we have to know that you have only 2 suppliers. And I know that when I say, do you still have the same 2 suppliers for the product you buy? And they say yes. And I send out the confirmation for the 2, and the documentation that I've asked, do you still have the same 2 suppliers, is we send confirmations to those 2 people. So I don't need to do additional work documenting my D&I because it's implicit in my confirmation of the same 2 suppliers as last year. Now the other question then was, how much testing do we do on sales? And we knew, the public knew, this was a publicly posted selling price throughout the year, and it didn't change that much while I was doing the audit. It was kind of the same. It was $2 a unit. We all knew that. Everybody knew that. So what we did was we divided dollar sales by the units purchased, fiddled with inventory. Now in the case of this client, their inventory was couldn't be much more or much less than it was at the beginning and the end of the year. It was just characteristic of the client. So we compared sales per unit to what was expected, and we stopped because it was $2, as it always had been. So how much work do we need to do on internal control, cash receipts, sales? They had a great system. They had, cash received, going in Brinks trucks, all that kind of stuff. We did no work. Tiny amount of D&I maybe just to document, but it was implicit in our analytical procedures, and no testing of operating effectiveness because we didn't need it. We'd got it. Now this applies to many entities. A daycare, where all the revenue is from the government, and you send a confirmation. There's no further testing on revenue. We sent a confirmation. Don't care. Now the other thing about D&I, it's only mentioned twice in the handbook in the context of doing an audit, and both times it's in the appendices. So it's not in the standard proper. And it is mentioned other times in the context of a firm has to have internal controls, quality control internal controls, and they have to have them designed and implemented. So that's mentioned, but in terms of client auditing, no. In 315, it's suggested that maybe we do it by inquiry, observation, and inspection. And in 320, it says, efficiency tip, maybe, think about it, you're going to test D&I and operating effectiveness at the same time by doing, and they don't say systems walkthrough, but that's what they imply. So your systems walkthrough tests D&I and operating effectiveness at the same time, and you don't need to document separate D&I because that's implicit. And if somebody says, hey, you need to, you refer to section 338.21 and say, no, I don't need to. So operating effectiveness is only attested if you need evidence from control. And if you don't need evidence from control, you probably need to do very little on D&I. Think about it. Now the other thing about documentation, and I kind of mentioned this about the previous slide, my favorite paragraph, 320A7, it is unnecessary to document separately matters if compliance with standards is shown by other documents in the audit file. And then they list a lot of things. Having an audit plan documents that you did audit planning. And there are a bunch of things in standards that says in audit planning you should do A, B, C, D, E. And if somebody says, hey, where did you document that? I have an audit plan. And that documents it all. And go read 230A7. So that applies to many things. And I sort of referenced that a couple of times on previous slides. So it's right in standards. Helps you be efficient in doing documentation. Now the other problem with documentation is audit budgets are relatively fixed. They don't suddenly go up a lot each year. So the more time we spend on documentation, the less time we're spending doing on audit work, and that's a bad thing. So a heavy focus on documentation is bad because it's taking time away from doing audit work. Now I have a phrase I call documentation artistry, where you make it look like you did something by fancy documentation, or you document the same thing multiple times. Okay, so documenting so it looks like something was done. And I have a favorite story about an audit senior who they were having a problem in a section getting something to work and be explained, and finally he just took a pen or sat at the keyboard and wrote something down and showed it to the junior. And the junior said, "Oh, that's perfect. That solves our problem. That describes the audit work and it solves our problem." And the senior went, no, read it again. And the junior read it again and went, "Oh, that actually doesn't say anything, doesn't mean anything. It just looks like we did something and it solves a problem." That's documentation artistry. Now another thing we got to watch is, I was once asked a question by a practice inspector, and this is about how much analytical procedure work had been done on a review engagement. And they said, "Wouldn't you agree with me that not enough analytical procedures were done?" And I said no. And they went, "Oh." And I said, "Well, standards require that we do it, but I think, we did here, we did there, we did here. I think that's enough. It's a matter of professional judgment. I think it's okay." And they went, "Oh, okay." Now, if I'd said, "Oh, yes, I agree with you," then I would have got a big thing saying we don't do enough review or analytical procedures in review engagements. Now, I'm not doing my files for the practice inspector. I'm doing my files so I do an appropriate amount of work and don't miss material misstatements, both in audits and reviews. Now, I went right away to my partner and said, "You've done some, and I've told the practice inspector I think it's okay, but between you and me, I really think you should have done some more. So how about that for next year?" And he thought about it and went, "Yeah, okay, I'll do more next year." So no, I don't agree, but I didn't tell my partner that they should do some more. Now, over documentation, people love documentation. Practice inspectors love documentation. Practice inspection depends on the theory that by looking at documentation, you can tell whether the work was done properly. And as I described to you before, no, you can't. That's an incorrect assumption. Just looking at the documentation could be fake, the documentation could be documentation artistry, but it makes the file look pretty, and it wastes time. And it takes time away from doing the work. So here are some examples of over-documentation that makes files look great. NAFWR, no further audit work required. I had been working in national office, developing and implementing the new firm audit approach, developing all the things that were required by the new firm audit approach, came back to the local office where I worked, and found NAFWR. And it was abbreviated by the initials. It was initialed, and it was double underlined in red, obviously on working papers at the time. But that's the kind of thing that really sounds like it was official, right? Initialed, not just single underlined, but double underlined and in red. And people in my local office were convinced that this was part of firm policy. And I had a huge argument with people. I finally had to have a course and say, "Don't do this anymore." But there were 20 times on a single working paper you'd see NAFWR. Took an enormous amount of time. And I don't want 2,000 conclusions in an audit file. I only want one. The single conclusion in the audit file is the partner at the end evaluating all the work done and concluding that the financial statements are fairly presented, or they do not contain a material misstatement. I'm prepared to accept one per section, because often one person does cash and another person does receivables, so each person, I suppose, should conclude. So I'm prepared to accept one conclusion per section, but at the end, the partner's got to review the whole file and conclude, based on the work done, that the financial statements are fairly presented. So I don't want 2,000 conclusions. The other one is purpose, procedure, conclusion. I don't get this one. but I see it all over the place and on every working paper, and sometimes more than once. And it's a waste of time because it portrays a badly planned audit. The purpose should be on the audit program. And the purpose of every procedure is the same. It's to reduce the risk of material misstatement to an appropriately low level. That's the purpose of every procedure. And the procedure doesn't need to be written down again on the working paper. It should be on the audit program. The audit program should reference the working paper, and we know where the procedure is done. And the conclusion, again, this is, 25, 30 conclusions in each section. Wasting time. I only want a conclusion on the section, and indeed, as I said before, one conclusion on the whole audit's all that's really needed. So purpose, procedure, conclusion on every working paper, lovely documentation, but a waste of time. So let's think about required audit procedures, and in particular whether these procedures are required in a less complicated audit. So the first thing that we often do is we often always send out a bank confirmation. Is that required? Are we required to send a bank confirmation on every audit? And confirmation only addresses the existence assertion. It doesn't address completeness, and it's probably completeness that we're worried about more here. If you listen to what the banks tell us, they say, yeah, we'll fill out your confirmation, but please do not think that we're giving you any evidence about completeness. Loans or balances, our systems, we try really hard, but our systems don't allow us to determine every loan your client has, every account your client has. So if you think you're getting evidence about completeness from a bank confirmation, you're not. And therefore the answer is no. It's not required on every audit. It depends on the risk of material misstatement and inherent risk. And if risk of material misstatement is low, automatically you probably don't need a bank confirmation. You can look at the client's bank statement, you can look up the balance online, you can find some way to do it quickly and efficiently without getting a bank confirmation. Accounts receivable confirmations. I had an experience with a practice inspector who told me that accounts receivable confirmations were required on every audit. And I said, no, they're not. They're not required by standards. And he went back to check with his head office. Now, they had an office with a door closed, but they had the speakerphone on really loud, and they talked really loud, and they were astounded when head office said, well, no, accounts receivable confirmations aren't required. Professional standards do not require accounts receivable confirmations. And again, confirmations addressed existence and not valuation. And probably in accounts receivable, we're more worried about valuation, allowance for doubtful accounts. So sending out a lot of confirmations doesn't help with valuation. And furthermore, what I often found is you wait and you wait and you wait, hoping, because you only got 20% reply. And you're hoping and hoping, second requests, and doing a whole bunch of work, spending a whole bunch of time, hoping to get replies. And at the end, you still only got a 40% response rate, so you got to spend time doing subsequent receipts work, which maybe if you just done the subsequent receipts work at the beginning, it would have been simpler. So accounts receivable confirmations are not required, and particularly in a less complicated audit, maybe they're not required at all, and there may be other simpler procedures you can do, subsequent receipts work, that solves the problem. Design and implementation and operating effectiveness. Actually, we've already talked about this. Not required, design and implementation. If we do not intend to get evidence from control, we need to do only the very least amount of work on design and implementation, and probably we can argue that the D&I work we did is documented elsewhere in the file by other things we have documented. So no, we don't have to do it. It depends on risk of material misstatement and our audit strategy and approach. Same thing for operating effectiveness. Don't necessarily need to test controls. We only do it if it's an efficient and effective way of getting evidence, and if we can do the audit in another fashion that's simpler, we're not going to do it. So that applies to systems walkthroughs as well. No, we don't have to do walkthroughs in every audit. Depends on risk of material misstatement and inherent risk. Examine fixed asset additions. kind of talked about this before. No, it depends on the risk of material misstatement. What do we think? What is the level of fixed asset additions? What is the risk that the client is capitalizing something they shouldn't? And it depends on our knowledge of the client, the nature of the client. It depends on our risk assessment procedures. We don't have to do it. Confirm accounts payable. Now, confirmation of accounts payable, again, that deals with existence, and probably what's the risk? A client has recorded an account payable. What is the risk of material misstatement that a recorded payable is wrong? If they've recorded it, it's probably right. What we're looking for is unrecorded payables. Confirmations don't deal with that at all as completeness. So we're going to be doing subsequent payments work to see, do we have any accounts payable that are not recorded? And then depending on our knowledge of the client, risk assessment procedures, all that stuff, we'll decide how extensive our subsequent payments work needs to be. And we're probably only going to send out confirmations in the case of very high risk of material misstatement. Another one I love is recalculating payroll. So we have a payroll check issued in January. We have a December year end. Check issued in January. What is the risk that we paid our employee too little? I'm willing to bet almost 100% if we paid them too little, a day later the employee was in the office saying, you miscalculated my payroll, you didn't pay me enough, give me more money. If, on the other hand, we overpaid the employee, they're probably, maybe they might tell us, maybe not. And there are many jurisdictions where if you overpay someone, you're not allowed to ask for the money back because it might cause the employee hardship. So if you've overpaid someone, A, they're not going to tell you. And if you haven't found out, and it happened back in January, financial statements are not materially misstated. You paid people more than you intended to. Management would argue there's a mistake, but the financial statements, payroll expense is correct. So recalculating payroll is almost a complete waste of time, not required. Probably better to do something analytical, looking at year-end payroll to see if it looks like employee deductions were calculated right. When they hit the maximum, they stopped, kind of test. The other thing is, if you have a major payroll service doing your payroll, what are the odds that they did it wrong? And what are the odds that you can deal with that with an analytical procedure? So recalculating payroll, not required, depends on risk of material misstatement and inherent risk, and depends on the other procedures available. So all these standard required procedures, we always send a bank confirmation, we always send receivable confirmations. You're probably making a less complicated audit more complicated, and you could do it more simply. And you could do a more complicated audit more simply too. Same logic. The only single required procedure in professional standards is we must verify the existence of inventory. So we kind of have to count inventory. We have to attend the inventory count. Now, we don't necessarily have to attend the year-end inventory count. I've done December year-ends where the client and we counted inventory in November. I've done inventory counts where the client does a cycle count, and they're constantly counting inventory. So we went out and watched the cycle count being done. We had verified the existence of inventory. And then we used analytical and other procedures to get us to year-end. So that's the only thing we have to do and cannot get away without, though sometimes you can, if the inventory is in a third-party warehouse, confirmation addresses the existence of inventory. If you've got a reliable third-party warehouse. So that's the only thing in all of auditing that you have to do regardless. So, doing what we did last year. Procedures accumulate. It's not responsive to risk, and we might miss a risk. If we just keep doing the same thing we did last year, what happens if a new risk arose this year? We're not going to address it. Or we're not going to notice it till the very end of the audit, and then in a mad dash with lots of overtime, we're going to have to do procedures to address that risk. But we're also doing a whole bunch of work. So every year, some enthusiast adds another step, something that they remember from an auditing course and saying, oh, we should do this. So they add the step in. Doesn't respond to risk, adds a step. So the risk may never have been there, or it may have gone away. And now sometimes the first time you're doing an audit, you got a brand new client, and I was told a story one time about the manager said, you know what, I'm not entirely sure about inherent risk. So I want to do this procedure because it's going to tell me, first of all, whether or not there is a risk of material misstatement or whether I should even be thinking about this at all. So we're going to do it this year. It's going to help us understand the client, understand the system, and then if it works out okay, I'm going to take it out because I'm now concluded the risk was never there. So got to look every year. If we're doing a whole bunch of procedures, we got an audit program, and then in the file we're doing a whole bunch of other procedures not called for in the audit program. What's going on? You want to be inefficient and ineffective? That's the best way of doing it. So each year you need to plan the audit in response to risk assessment procedures you've done this year and your assessment of risk of material misstatement this year. So if you say, oh, I really don't want to waste a lot of time thinking, I don't want to do that, I just want to get out and start doing the audit. Don't ask me to think about what I should do. Well, then you will waste time doing too much work and overtime and doing stuff that either you or other people on the job are going to go, what are we doing this for? It's idiotic. There's no point to doing the test. If you want to do it that way, you can, but you will do too much work and you will be inefficient, and you will say, well, we need new standards for less complicated audits because I'm doing way too much work. Well, use the current set of standards to do the right amount of work. So things that waste time, queries, almost all of them, discussed that before. Not planning, that is not in accordance with standards. Standards say you've got to do planning. So if you skip that step and say, oh, let's just get out and start doing work, you're not following standards. Not following the plan, assessing risk as low and then doing a high amount of work, it's going to waste your time. Not following the risk model. Sort of went through mathematically how that works. Too much documentation. Documenting. It's not necessary. It's not required by standards. Some documentation documents other things. Think about that. Too much documentation, waste time. Auditing without thinking, waste time. If you say, oh, it's too complex, let's just start. Going to waste your time. And doing what we did last year will waste time. So, thanks for listening.